My name is David Berkowitz. I am the Chief Investment Officer and founder of Value Line Partners, a Red Bank, New Jersey investment management firm. This is part 2 of the 5th educational video in our series of 6. In part 1, we discuss how to pick the companies that are value aligned. Can you believe that according to our research, only 10% of the public companies in the United States manage for value? We identify and own those shares of those companies that do manage for value. But how do we find them? This video gives you the answer. It's all about economic value added, or EVA, and managing for the long term instead of the short term. We look for and invest in companies that make decisions that maximize expected value, even at the expense of lowering near-term earnings. Most companies evaluate and compare decisions in terms of the impact on reported earnings, that's reported accounting earnings, when they should be measuring against the expected incremental value of future cash flows instead. Take the U.S. automobile industry. Their modern troubles were born as early as the 1950s, when their unions settled for smaller wage increases in the short term in return for higher pension and health care benefits for their members in retirement in the long term. This increased short-term earnings for the companies. Their executives received bonuses based on those increased profits, but as we know, those pension and health care obligations for retirees bankrupted General Motors and Chrysler in the aftermath of the financial crisis. If a management makes bad decisions in order to hit short-term earnings targets, no amount of subsequent brilliance will overcome the damage that has been inflicted. Warren Buffett. And so it is with so many companies. Things haven't changed much since the 50s. There's no disputing that many business leaders do manage for short-term results. In one study, 1/4, that's 1/4 of chief financial officers of public companies said they'd make large economic sacrifices, for example, cutting research and development spending today, below optimal levels, just so that they could meet Wall Street's quarterly earnings expectations. Other types of research support that general point. So what's the answer? The answer is to focus on economic value added and forget about the earnings management game. What is economic value added? Well, EVA is first and foremost a governing objective. What is a governing objective? It's the way to keep score. It answers the question, are we winning, losing, or standing still? It's a clear statement of what the company is fundamentally trying to achieve. A solid governing objective also provides a benchmark for investors and other stakeholders to evaluate the company's performance. Most firms juggle a lot of measures all at once. They set targets for growth in sales and market share for the salespeople, earnings and earnings per share targets for the divisions heads and for the CEO. They use discounted cash flow for capital budgeting and valuations. They judge performance by EBITDA, margins, and returns. They base bonuses on beating budgets, not on actual performance. And they feature a diverse array of metrics and milestones on scorecards with no overarching objective or governing objective. Let's think about that for a second. What if I were to tell a basketball team, or better yet, pay the basketball players on the team for the number of points they score? What do you get then? You get runners and gunners. It's like telling employees of a company, just go out and sell as much stuff as you can at whatever price you can, or invest in whatever you want to, as long as it adds to earnings after you pay the interest on it. No return for shareholders, doesn't matter, just go out and maximize sales and earnings. In other words, score as many times as possible. Don't worry about defense or your shooting percentage or the quality of your chances, just run and gun it, cut prices, give other incentives, skimp on quality, etc. Let's take another example. What if I pay players for shooting percentage? Shots made divided by shots taken. What will happen? The players will be cautious. They will look to take the layup, the sure shot, and then call it a day. They will wait, delay until they have the sure shot, and then voila, 100% shorting percentage. One shot, one made. Pay me now, please. It's like having a governing objective based on what's called return on investment, which, like a shooting percentage, is a ratio, profit divided by investment. They wait and take the one sure investment that will yield the most for as little capital as possible, and then stop investing, stop selling, stop shooting. It's the wrong incentives because it's the wrong governing metrics. But what about a governing metric that says just go out and win? Then the players have to figure it out. One night their shooting percentage might be off, so they have to shut down the opponents on defense. Sometimes they're really hot, so they run and gun it. The point is that their trade-off between taking good shots, taking lots of shots, and playing defense. They juggle the many inputs, but with one goal, one overarching goal in mind, one governing objective in mind, and that is to win. It's the same with companies. Some companies have low margin but high sales, like Walmart or Amazon.com. That's called high velocity or high turnover. Some companies require little cash investment but lots of human capital and software, like Google. Others sell commodities and can't control their prices, but they know to win they must be the lowest cost producer. None of these metrics by themselves, sales growth, market share, margins, return on investment, is the goal in and of itself. EVA is. EVA is that governing objective. It's the overarching objective. All the other metrics flow into it or drive it. EVA is the definition of winning for companies. All the other measures are just drivers of that EVA. You trade one metric off against the other to see which one will produce the most EVA or the most value wins. Increasing EVA unites, speeds, and simplifies decisions and directly links them to adding value. Develops a common language, a shared mission, and a metric applicable to all the lines of business. In essence, it creates alignment. EVA is also economic profit, which is the profit to manage a business and to maximize value. Economic earnings are very, very different from accounting earnings. They represent the true cash flows available to shareholders. EVA is an estimate of what economists call economic profit, which can be determined by making adjustments to the generally accepted accounting principles accounting, or GAAP accounting, including you do things like you subtract, and the most important thing is you subtract the opportunity cost of all the capital, the debt and the equity. So you count the interest on your debt, but you also count the expected return on your equity or your shareholders' return. Conventional accounting doesn't care about shareholders. So EVA is a way to determine the value that's created above the required return for the company's shareholders. EVA is net operating profit after taxes, that's the profit measure, less the cost of capital in dollars. That's it. It's profit minus a capital charge in dollars. What's left over is the value added, is EVA. EVA is mathematically linked to intrinsic value, so maximizing EVA means maximizing value. The goal for a company becomes increasing EVA. So it doesn't matter if it's currently negative, you make it less negative. If it's positive, you make it more positive. It ignores the past and works for laggards and for leaders. The whole idea is it's about creating future value, and that's how all valuation is driven in the current state. It's driven by what's going to be driven, what kind of value is going to be driven in the future. And we don't get hung up on the past, as happens with so many other performance metrics. So in the end, EVA is just what's called net present value for real. Present value of EVA, as we can see here in the chart, is mathematically identical to the net present value of discounted cash flows, or what economists call intrinsic value. EVA best explains the owner wealth and total shareholder return. Instead of discounting cash flow, management should project, analyze, and discount EVA to measure and improve the value of its plans, its projects, its acquisitions, and its decisions. It happens with far more clarity, accountability, insight, and consistency. So let's go back. How do you calculate EVA? It's really simple. You just basically take a profit measure, NOPAT it's called, net operating profit after tax, and you subtract the capital charge, $100, which is just an interest rate times the amount of capital you have invested. If you have something positive left over, that's your EVA positive. If you have something negative left over, you're destroying value. So let's look back again. You have sales of 1,000, operating expenses, which are like salaries and electric bills and normal operating expenses. You have $700. You pay taxes of 100, let's say. You're left with profit after tax of $200. Then you take the capital that you have invested in the business, the stuff that's on the balance sheet. You multiply that by the blended cost of your debt and your shareholder equity, and you get, let's call it 10%, you get a capital charge of $100. So $200 minus $100, the hurdle rate, you're left with $100 of value added. It's really that simple. Profits minus a capital charge. So let's look at an example and see how it works. So now let's say that here we have the now. In this column we have the now period. We had $1,000 of sales, a 15% profit margin, net profit after tax, net operating profit after tax of $150, $1,000 of capital times 10% is $100, and we're left with $50 of EVA. Now we're contemplating a new project. We have $1,000 of sales we expect. We get a 17% margin, so it's even better than the existing margins. So $170, but it's going to cost us $1,800 in capital. That means a $180 capital charge. So $170 it brings in, but it's going to cost us $180 in capital charge. That means it's a negative 10 EVA. So it lowers EVA. By itself, we don't take the project. But let's look what happens to the other metrics. Well, margins go up. Wall Street's going to like that. Profits go up. EPS will go up. Goes up to $320 from $150. But the capital invested goes from $1,020 to $2,800. Capital charge goes up. Your return on capital and EVA goes down. So if I was focused on sales, you could see that if I told my salespeople I want you to give me sales, they would say, do this project. If I was focused on margins, because my investor relation officer tells me that Wall Street wants me to have higher margins, I would do this. If the CEO says, no, we are governed by whether it adds value, this doesn't add value, so they say no to the project. An example of this would be Best Buy. Best Buy, which was an EVA company, they decided not to carry very high margin musical instruments. You can pay a high price for them, but they don't sell as fast as all the other stuff that it's in the stores. So due to those slow capital turns, they had negative EVA. In other words, margins would have went up, sales would have went up, profits would have went up, but because of all the capital tied up in inventory, they would have been a negative value growth target, so they declined to actually carry musical instruments. Here's an example again. Now this is what happens, and these are the kind of companies we look for because they're completely misunderstood by Wall Street. This gives us an opportunity to buy companies, usually on the cheap, because Wall Street punishes them for the wrong metrics. So for instance, the same $1,000 of sales and $50 of EVA to start with. We have a new projected project of $1,000 of sales, but it only has a margin of 12.5%. So our margin's going to get diluted. Our margins are going to go down. We start at 15%. Now they're going to go to 13.75%. And the Wall Street analysts that are focused on our margins only are going to cry foul. And maybe they downgrade the stock and the stock price goes down. You can see that profits will go up. Maybe not enough, but profits will go up, so they'll be happy about that. And EVA goes up. EVA goes up by $25 because it only costs $1,000 in investment to get that $125 in net operating profit after tax. That adds EVA of $25. So our EVA goes up again, so we would do this project, even though our return on capital goes down. Return on capital goes down, and our margins go down. Sales go up, but EVA goes up, and that's the governing objective, and that means we would take the project. Here's an example. CSX was an EVA company, and they went intermodal. What that means is they added trucking freight to their line of business, and that means they would deliver to trains and then take from trains for more local deliveries and local transport to the trains themselves. And in that way, they could add sales, but the margins were very small on the trucking business. But it didn't require nearly as much capital as buying a whole bunch of new locomotives. So the capital was less. The capital charge was less than the amount of incremental dollars of profit. So they took the decision. The same thing when Coke adds a new line. Coke added Cherry Coke. Its margins and its returns suffered, but its EVA went up. So Coke now has a whole variety of different colas and drinks. Even though margins aren't as great as their flagship Coca-Cola, the Cherry Coke still added value, so they took that decision. Now, the mother of all misunderstood stocks is consistently Amazon.com. So the question is, what is behind Amazon's booming stock price? In fact, Fortune magazine wrote in 2010, I think, or 2012, I can't remember. But they wrote that the media's Vogue stock market story of the moment is the mystery of Amazon's share price. The company shares keep beating record highs. The New York Times, The Atlantic, Slate, Bloomberg, and so many others point out that Amazon hardly ever reports a substantial profit. And in most recent quarters reported an actual loss in EPS. But the company keeps booming, and it's among the most 20 valuable companies in America. It's worth more than AT&T and Coca-Cola. And the question always is, what gives? Why is this another sign of a bubble? It turns out the answer, though, is Amazon actually performed spectacularly well over the past decade. The performance mirrors the stock price because it's not revealed in their financial reports of the company. It's revealed in EVA. So the bottom line number most frequently talked about are those earnings per share, which at Amazon has been declining for 3-4 years. But it's not what matters to investors. What matters to investors is future economic value added. So research shows for years that investors don't care about EPS, they care about EVA, and Amazon turns out to be a near perfect example of this phenomenon. You can see that EPS is down, but EVA has steadily been increasing and exploding in recent years. This year, Amazon.com stock price is up 120% on the year alone. On the year alone. And so there it is. We look for companies that are managed like Amazon, where Jeff Bezos is known for investing for today, regardless of what Wall Street thinks about it, because he knows that he's going to have huge returns in the future, and they keep piling up those future intrinsic value moments, and then Amazon's stock price responds because sophisticated investors understand what's going on. Now I want you to watch this video which talks about two companies, Ball Corporation and Dow Chemical, and how they use EVA to create alignment and to create value, and then we'll be done. And so let me say goodbye for now, and have a great new year. Thank you. Bye-bye.
Behaving like owner is EVA. You know, when you really are an owner, you worry about where your capital is going and how you're earning returns on that capital relative to other alternatives.
We always have questions from investors that invest in us, and we say, no, you invest with us, because we look at this as our money.
That's why all of our incentive compensation programs, starting from hourly people on our plant floor all the way up to us, they're all aligned with a similar philosophy, and it's all about EVA dollars.
This is your money. What would you do with it? Would you make that investment? How do we generate more revenue? How do we take out costs? How do we use capital more efficiently? If you think about it as your money, and EVA is all about it's your money, what kind of decisions would you be making? And I think it makes decision making much more simple, logical, straightforward.
Yeah, someone once said, you know, it makes the meeting shorter, and it does. It does, because when you have a common sense of purpose and you have a common language about it, and people understand what that language is, you don't have to have debates. We've been very fortunate that our company has never been capital restricted because we're good stewards of our capital. Said another way, we invest for the long term based on EVA principles, and when you do that, you have a solid, healthy company from which you can generate more opportunities as you go forward.
Let me give a couple statistics, and this comes right from Ball's 2014 annual report. If you go back 5 years ago, EVA was running at about 109 million, and by 2014 it was 190 million, almost doubled over that 4-year time span. And that is clearly translated into total shareholder return. The total shareholder return over the past 5 years has doubled. The value of the company over the past 10 years, $100 invested in Ball stock would compound to $340. Ball has clearly outperformed, you know, its peer group. So apparently EVA worked. Welcoming Andrew Liveris here today to give us some insights into EVA at Dow. So Andrew, in your words, how does Dow use EVA?
So EVA, economic value add, and all the principles that underlie it, Ben, are very crucial as one of our large financial metrics that we use to run the company. Our businesses need to run, and our business managers, where the income statement and the balance sheet are integral to the decision making. EVA provides us the tool and the mechanism to actually bring the two ways to measure value together. And we actually have made it part of our operating metrics, weekly drumbeat of analysis.
How did you take some steps to communicate EVA to investors? Would you mind describing that and your experience with it?
That has permeated the investment community, and these reports, the ones you referenced, there was one just the other day from JP Morgan, the same thing. People are starting to say, you know what, these guys really are efficient capital allocators despite the complexity of their business. Because the complexity of the business translates into trying to simplify us. If you can simplify us based on a metric that understands that we are actually efficient capital allocators for growth, then actually they can kind of get it.